Hi everyone, and welcome back to the Property Trio. Probably good and bad news for this episode. Good news is it's market update, which we love, and we're bringing you all the data from June. The bad news is that one of the crew is missing. Dave is gallivanting around on holidays, but I've got Cate. So, I feel like we've got enough ingredients to put something together. What do you reckon?
Yeah, we'll have a bit of fun with this.
All right, so RP data, core logic, coitality. What do we call them these days?
Oh, I'm not happy with Cotality.
Not
Their new
coitality,
reports.
because that's I think that's sex.
Oh gosh,
Cotality.
we're not even 30 seconds in.
Oh,
Oh,
sorry
what do we
about that,
do with you?
listeners. Yeah. Okay, let's just call them core logic because that's really easy. What is interesting, more so than changing their name, is that they've split up the monthly data into houses and units and then all dwellings, which I think is fantastic. It's a bit of a difficult thing to read, but it's good that we've got that segmentation because that tells some interesting stories. But if we start with the macro and we look at all dwellings, everything is up except for Hobart. Now, Hobart's one of those interesting ones where I've sort of taken on a little bit of a kind of a thought experiment about picking the bottom of Hobart, and I'm keeping an eye on the listings, but negative 0.2%. Everywhere else is up, but the big story is, of course, Darwin. What are your takeaways from the macro print, Cate?
Yeah, Darwin continues to reign, and we've got a chart coming up that we're going to talk about because it really focuses on Darwin. And interestingly, not every suburb in Darwin is at its peak. In fact, it's a disproportionately small count when we compare to the other capital cities that are at peak. Darwin doesn't have a large number of its suburbs that are all behaving uniformly. But if we step away from that and have a look at the figures, the broad figures, there are certainly some suburbs that are doing very, very well. And I imagine if the figure that we're looking at 1.5 for the month is just covering a third of the suburbs that are at peak, then the ones that are performing would be doing very, very well.
Mm. And for houses, it's 1.8% for the month, which is interesting.
Yeah.
It's showing that the investors are definitely favouring that. But a couple of weeks ago, maybe it was the last market update or in and around that, we were looking at the differential between the performance of houses and units. And units are kind of at the bottom end of the cycle from memory. And we were
Mm.
kind of talking about whether there is potential upside for units. And, not all units are created equally. I'm guilty of always kind of thinking about units as high rise, but there are quality blue chip investment style units that are, properties that are built in the 40s, 50s, 60s, minimal common, minimal lots on a big block of land. So you still have a reasonable land to asset ratio. So there is
Yeah.
some good buying out there for people that are interested in units. And very interestingly, in Brisbane and Brisbane, including the Gold Coast, as well as Adelaide, units actually outperformed houses for the month. Now,
Mm.
you would caution me to say a month is not a trend line, but I
I would
wonder, is
indeed.
this a unit resurgence?
Look, I have talked about units in my own home city, and in fairness to the show, I'm active in Victoria and I have to read a lot of data to understand what's going on in other markets. But anecdotally, I can see that there's definitely a correlation in terms of a willingness to participate in the unit market as an investor and as an owner occupier in Melbourne. I just wonder if we're seeing that in other cities as well. And, COVID might have had something to do with this swing because our city was really, out of bounds for a lot of people during lockdown. We were the most seriously locked down city globally and in terms of tenure. And we've seen a lot of people want to return to the city, whether COVID has influenced that or whether working opportunities have changed that or the city's come back to life. I think that there's been a real mind shift since people were in lockdown and opted to move away and, didn't love the city at the time. They've fallen back in love with it. But what's going on in other areas, it's affordability as well, Mike. There's no doubt
Mm.
about it. borrowing capacity, rental yields, the hip pocket really strikes when people make purchasing decisions, whether they're owner occupiers or investors.
I was just about to say, I think affordability definitely comes into the equation as well, because if we think about, well, I mean, I've shared our data that 650 is the average investor spend for last calendar year. Removing outliers, it goes down to 550 when we're talking about some of the $1 million ones that are smattered into our data. And 23, 24, you could go to Brisbane, Adelaide and Perth and buy something at that price point. Now those markets have kind of shifted. You still have houses in Darwin and probably Hobart, but if you want to go anywhere else and you've got that sort of budget, you're either going way out from the city or you are having to look at a unit at that price point. And I think some people value the proximity to those amenities more than potentially having a house that's an extra 20-minute drive from the city. What do you think?
Yeah, I absolutely agree. And for an investor, we need to talk about yield, and that will come along a little bit later in the show. But we're seeing some really good yields. I'm purchasing properties for investor clients who are opting for apartments, and they're getting over 5% yield. That is
good.
really strong for Melbourne. We haven't seen that for a long, long time.
That is an interesting one. Now, the updated format means that we get houses and units segmented, but we lose our quarterly percentage changes. But thankfully, in their pack, they've shared some 3-month changes. So Australia as a whole, we're up 1.4% over the quarter.
Yeah.
And regionals are 0.2% up on that. Things seem relatively in lockstep at the moment, although the combined capitals has had a little bit of a dip. But if we look at some of the standouts for the quarter, I mean, Darwin's the big one, right? It's all about
Yeah.
Darwin, where we normally had, Perth, Adelaide and Brisbane off to the races. They are still pushing a little bit. They're not at the peak yet, but the fundamentals are definitely really slowing down. But Darwin at 4.9% for the quarter, that's big.
Oh, look, I'm shocked by it all. And I'm looking at regional Northern Territory. It's showing just 0.6% growth there. But if we correlate that with the 12-month chart, that was in negative. It was over the 12-month period, it's minus 1.9. And when we look at the 12-month chart, Darwin's not doing anything special there at all. It's in line. Oh, I shouldn't be so blasé. It's almost at the same level as Perth, Adelaide, Brisbane for the 12-month block, but it's been a stark change. So the last 3 months, that last quarter, it's really registered and got itself on the map as the outperformer.
It's really, really picked up quite a lot of steam, hasn't it? And if we
Yeah.
zero in on Darwin, some of the great data that we got, as you referenced before, is that only 31% of Darwin suburbs are actually at the peak. And so Darwin has just gone to has reached a new peak after 11 years. The previous peak was 536,000. We're at 537 now. But an interesting pathway to that new peak, isn't it?
It is indeed. And when we look at other peaks, let's talk about the outperformer for the last 12 months out of all of the capital cities. It was Adelaide. It topped the pops at 8%. And when we have a look at the quarterly data, Adelaide is the second slowest. So has it come back? I would argue that we still need to see a little bit more data, but it's certainly suggesting that Adelaide's had its run.
So when we're looking at Darwin, we see from the previous peak, we had a protracted period of declines, and then around about COVID, it started its trajectory
Yeah,
on the
it
up
did.
climb, but really has only sort of made the news in the last 6 or 12 months, anecdotally, and
Yeah,
now
which is a
in the
bit
data.
unfair because the data's showing in that latter part of lockdowns and COVID mess that it had a really sharp trajectory when it ticked up. We didn't really talk about it then, but they've got an interesting chart, which I'll pop into the show notes, showing that the 5 years prior to COVID and then the 5 years from COVID and onwards, the downturn and then the uptick. And it was a downturn of just over 26% and then an uptick of just over 36%. And it's very interesting seeing how volatile it's been, and it's a great chart for a visual.
Mm. And when we're looking at the metrics where the percentage of suburbs where the dwelling values are at the peak by region, Darwin's
Mm.
only 31% of its suburbs, as distinct from Brisbane at 78, Perth 74, Adelaide 61. That's a
Yeah.
very interesting proposition there with Darwin. I think what's obviously different is Darwin is really at the beginning of its upswing, whereas the others are at the back end. But I also kind of think that places like Perth, we had investors obviously targeting specific areas like Rockingham and Mandurah and places like that. But in
Mm.
Darwin, I suspect there's some really tight areas where they're seeing the majority of the activity. What do you think?
I have asked myself this question, how can one very small city exhibit so much strength, yet only less than a third of its suburbs are at peak? I mean, Darwin's hit its peak and it's done so in style, but I'm just wondering why two-thirds are trailing or have been left behind. There's a couple of thoughts here. Obviously, it's only just hit its peak, so we would expect to see that figure surge upwards. But the other thing that I'm thinking about is there's a lot of activity, investor activity, and a lot of these investors and their BAs, there's been a huge number of buyer agents going into Darwin. A lot of them are these data-driven new breeds who they're purchasing the data, and I'm not going to be as harsh as say that they're following it blindly, but they're following it. They're following it, very prescriptively. And I think that when data is giving you this insight and naming specific suburbs, they might have only covered a few suburbs in Darwin in this particular report. And so if you've got a really strong cohort all just targeting a certain limited number of suburbs, you will see a surge in just those postcodes alone, and that might be an explanation as to what's happening.
Mm. It's an interesting one, and I guess we'll see as Darwin continues to grow. I mean, it's only just surpassed its previous peak. If it continues on that trajectory for the next 6 months, which it probably seems like it will, just based on the data lag, if anything, then that number should increase. But yeah, if it doesn't reach 60% or above in the next 6 to 12 months, it speaks to the fact that there are very specific suburbs that are seeing the majority of those transactions, which is an interesting one. What's also interesting is when we look around the country at the different quartiles. So if we contrast the lowest 25% of values versus the middle and the highest values, typically we always see a certain pattern. The bottom end of the market does best. So the graph kind of looks like a nice, neatly declining thing from low to middle to the highest level. But there's one big outlier that
Mm,
ruins the beauty of that chart across the
100%. It's
country.
just an
Talk to us about that.
anomaly. Yeah, so Sydney, Melbourne, Brisbane, Adelaide, Perth, Hobart, Darwin, they're all showing that pattern. In fact, there's one that's slightly out of whack. Perth is showing the strongest performance in the bottom quartile, and then the second strongest in the highest quartile. So that's a little bit odd, but the figures, they're all very close there.
Mm.
It's Canberra that's showing the complete opposite of what you've just described. So the bottom quartiles delivered 0.5%, the middle quartile 1.2, and the top 1.8. What's happening there in Canberra that's causing the greatest gains to be in the highest end of the market? I think we know the answer.
The red team. So,
There's and also job confidence. So
yeah.
you see people holding back when they're nervous about their tenure and their contract or their employment. And when you get an election result that's strong, that obviously gives anyone who's in a government position in the Labor Party a really strong sense of job security, and then they
Mm.
might be prepared to go and make a purchase decision.
Yeah, and I don't have the number offhand, but I remember speaking to Claire, who's the buyer's agent par excellence down there. I actually interviewed her on my other show recently and basically was asking the question, is the ACT ready to go for investors? You know, what opportunities are there? And I think, spoiler alert, the answer is, well, not really at the moment, and the price point is probably minimum 750, which is above kind of the price point that most investors are transacting in our data. But I think the election is disproportionately important compared to previous ones because Dutton kind of went with the strong arm sort of Trump-esque tactics, like Elon Musk taking the chainsaw to the public service. I mean, he was basically saying that they were going to axe 40,000 jobs or something like that.
Yeah.
Obviously, he got his backside absolutely crushed in that
Yeah.
election. So the people that impacted, well, I mean, the vast majority of them are going to be Canberrans. So they're a little bit
Mm.
more confident about their job prospects and quite happy to look at those upgraders and maybe those forever homes.
Yeah. I think that's what's transpired. It's probably the only city where we can have a look at a cohort that's that significant in the employment sector and draw some parallels.
Mm. So, what's interesting to me from a headline point of view as well is that Melbourne has only done 0.5% across all dwelling types for June. Sydney did 0.6%. And really, it feels like there's a lot more activity happening in Victoria than, well, let's say Melbourne rather than Sydney.
Yeah.
And curiously, when it comes to rental growth, Melbourne is underperforming, and I want to ask you about that, but preface that by saying we've seen the data from Victorian rental bonds.
Mm.
We produced a research project that I think we talked about on the show some year or so ago, where we predicted around about a 4% drop in rentals in Victoria. The rental bonds data came in and it was way worse than that. So a lot of people have exited the rental. Well, a lot of investors have left the Victorian and market, but then
Yeah.
we've seen an uptick recently. But the rental growth is really low,
Yeah, it is indeed.
1.2% for 12 months. Is that more
Yeah.
about the old story rather than the new? I wonder.
It is about a new story, and I've already conceded defeat on my prediction that we would see rental growth become really problematic into this year as well. I was so sure of that being the case, but I'm wrong. And what we've seen happen here is obviously first and foremost less new arrivals. You know, our
Yep.
our migration figures are significantly lower than what they were last year. And yes, we've still got more people coming, but we're also very aggressively getting into, um, new builds. And we've seen things settle down since COVID. We've seen people repartner. We've seen house sharers move back in together. We've also seen first home buyers getting some really good opportunities. And I think all of that has come together. But the big and most recent one is we've got a lot of renewed investor activity from interstate. So we're talking to property managers on the ground here who are saying previously, a year or two ago, you'd get multiple applications on the very first open. Or if you got lucky and you could get the photos as part of the deal and advertise the property prior to settlement, you'd have people already wanting to apply before they'd even seen the property. So those days are potentially behind us. We're now having to have the open for inspection, and sometimes it doesn't lease straight away. I still think it's a very tight market. I haven't had any clients that have had to wait longer than a fortnight to get a tenant. Most of them have been, still on the very first open. But yeah, it's just eased a little bit.
Mm. And yeah, I wonder, like with places like Darwin, 6.2% growth in rents. I had a bit of a theory that what typically happens with rents is that when properties turn over, rents will increase because we
Yeah.
always tend to have tenancies that have been in place certainly for 12 months or more are typically below market, because investors
Yeah.
don't actually take every active opportunity to increase the rent. Either their property manager is not proactive, or they're happy with the tenant and they kind of think, oh, is it worth upsetting them for an extra $10 or $20 a
Mm.
week? So I'm wondering if that's the reason why Darwin rents have soared so quickly, despite there being lots of new supply of investors. So maybe that will be a flash in the pan. So is it
I
the
agree with
timing
you.
thing?
Look, I think what you're saying has a lot of merit. I also think that when investors purchase a property, they'll make little improvements as well. And
Mm,
so, whether it's putting in an aircon or doing a new kitchen, they'll get things done because they're wanting to bolster the rental yield. And I think that we can see that's been pretty obvious in Darwin, that
mm,
it's been hit really hard by investors. And you know, as I've just said, investors will get a property in tip-top shape, whether they're wanting to just generate better returns themselves, or whether their property manager is saying, get it to its best standard so that we can get a really great tenant who will be prepared to pay for those things, and also really look after the property. It's an old and well-known saying, the standard that you provide is often the standard of care that you see applied to the property. So if you hand a tenant, a dog of a property, you can't expect them to take pride in it and look after it.
yeah, absolutely. So that's an interesting one. Which will we see Melbourne increase because it's a little bit behind Darwin, or is it likely to increase as more investors pile in and update their property and update to market rent? Who knows? Time will tell, I
Mm.
guess. But you prefaced earlier in the show yields. If we look at gross rental yields, they've been sort of somewhat flat across the country for the last little
Been
while.
pretty
But
static. Yeah, since
yeah,
the end of COVID, really. We saw gross rental yields really hike up from, I'd say late 2021, and it was a really sharp trajectory. And that's when we, had all of the tenants unions and articles and TV shows and media clips with just everything was about the housing crisis.
mm,
And it's really stabilised since early 2023, and it's just static now, and it's sitting nationally at 3.7%, which is a very good figure nationally. But if we cast our mind back to um, early 2019, it was sitting at 4%. So it's been a little bit of a roller coaster, and the yields really dropped from 4% down to probably 3.1% in a
mm,
pretty short space of time over COVID.
mm. Darwin's leading the charge at 6.5%. Regional NT, I mean, that's always absolutely bananas at 7.7%. Regional WA, 5.9. But yeah, across all of the regions, they're all above 4%. And it really takes only Hobart and Perth and Darwin, well, and Canberra, I suppose, to be above 4%. Everywhere is around that 3.7, and Sydney at 3.1, which typically is a bit
Mm.
lower just because of the asset values. Now, listings. I'm interested in what the listings data means for you as a buyer's advocate. I presume that when we're looking at things like an 11.7% drop in new listings from the equivalent period last year, there's a lot less stock available
Mm.
for you. And it's funny because when I first sort of started chatting to buyers agents and the market was going off, I would sort of say, "Oh, this must be really good for you," and then buyers agents would say, "Well, no, it's actually really, really difficult. It's a flat market that's a lot easier for you to transact in." What is it like when listings are tight, such as they are at the moment?
It's difficult because buyers recognise that there's nothing on the market, and they kind of scramble. They get fearful that that's the new status quo, and if I don't buy something now, the market will gallop past me. So you see a little bit more irrational buying behaviour when listings are really tight, because people, they forget that this can change. Sometimes it's seasonal. Obviously, we're looking at last year versus this year, so that's
Mm,
annual. and it does feel a bit tighter. So what was causing more people to sell last year? Well, we saw a few things last year that triggered people wanting to sell. A big one was tough interest rates. We saw a lot of investors and a lot of holiday house owners, and also, a lot of downsizers or downgraders making that decision to sell because the mortgage repayments had just got too much for them. We also saw a lot of regretted decisions, certainly in my neighbourhood. A lot of people that desperately made a big bold decision during lockdown, purchased something, and then when lockdown came and went, they realised that it probably isn't a great long-term solution for them. But the data that I'm looking at here, Hobart and Darwin, they're more than 30% down on last year. They're big markets. I know they're not as big as all of Melbourne and Sydney, for example, but they're significant markets. We're not talking about tiny regions. And that's a very big discrepancy. I think regional Northern Territory, it's at almost 50%. That's a really hard one to talk about, because regional NT is very diverse, and it's an enormous geographic span, and some of the locations in that mix will be very small towns, but all of the figures are showing that we're down.
Yeah, and I suppose if we look at around some of the other locations, Perth is probably, after Canberra, the one that's closest to last year, but it's still nearly 10% behind. But yeah, Hobart and Darwin over 30%, Sydney, Melbourne 14 and 12 roughly, with Brisbane
they're tough.
14. Yeah, so it kind of says, well, that puts a little bit of pressure on the demand side of things, just by virtue of there being a lack of a supply. And when it comes to Hobart, I guess people feel like it's not a good time to sell because the market's been having a bit of a shocker. And with Darwin, well, it's not maybe a good time to sell because they can see that the market has started to gallop.
Surging.
Who wants to sell halfway on the upside? So two very, very different reasons why people might not be putting their property on the market.
Yeah, look, I think a lot of vendors, and we'll see it in the Westpac consumer sentiment data, vendors know that, well, the data suggests that vendors believe that the market's going to strengthen. So for vendors that don't have to sell, they won't sell. They'll just wait. They'll hold out, especially downsizers. Now, what intrigued me with this chart was the total listings. We've seen Adelaide and Perth exhibit positive. So everything else, Adelaide, Perth, and tiny, tiny movement for Canberra, everything else is negative. So that's showing us that they've got a larger total number of listings, and that's because stock is sitting around on the market for a bit longer. So the older stock, and I don't know what the number of days is, it's old listings are 180 days plus, but this is just showing anything that's not this month. So stock is taking longer to move in Adelaide and Perth.
I think that is fairly strong evidence that those markets are past their best, and we've seen that the last couple of months. They're not posting 1.5%, 2% a month like Perth was, but with Adelaide and Perth being in positive territory, Brisbane in slightly negative territory, it feels like Brisbane is the more resilient of those three markets. And anecdotally, it does seem to be the case. There are a lot of investors that are actually actively trying to exit the Perth market rather than hold. Adelaide, I'm not sure if it's quite the same, but Brisbane, there's still opportunities there. There's still a bit of activity. So interesting to see if Brisbane does run a little bit longer than the other two.
Yeah, absolutely. If we have a little look at Sydney versus Melbourne, Sydney for the month is showing that it's got a greater deficit of new listings than Melbourne. But for total listings, Melbourne's got the deficit and Sydney's in balance. So what that's saying is Melbourne's older listings are still being absolutely picked up by purchasers, whether they're investors or owner occupiers.
Well, there is. I mean, I feel for you, because it seems like for months and months and months you've been predicting Melbourne to hit the numbers, but the story's out there. Like, you speak to people that are active in Melbourne, and obviously you know better than anybody what's going on. But just in me speaking to people that I know are busy and active in that location, it's competitive, but it's
I've
not
got a real
really
theory
shown in
on
the
Melbourne.
data.
Well, there is one reason why it's not, and obviously the segmented data with price points really helps with backing up my theory. Our median sales values are lower because we've got so many investors targeting the lower priced houses in the market. If you chat to someone, well, Frankston has topped the pops for the suburb that's delivered the strongest growth in recent times. It's Frankston. Now,
Yep.
Frankston is circa 40 k's from the city. It's on the coast. It's actually not a suburb that you can just use one broad brush to describe it, because there's quite a few segments to Frankston. You've got Kooringal and Frankston South, Frankston North, Frankston City itself, Oliver's Hill. So it's diverse, but it's a lower price suburb generally, especially where the investors are targeting in Kooringal and Frankston North. You're talking like circa 700, 800 markets. And we're seeing a lot of those markets getting a lot of activity. And if you asked an agent in Werribee, for example, or Sunbury to talk about what's going on there, it's hot. It's really competitive, and the growth is very, very aggressive. I was chatting with Lisa Parker yesterday, who covers a lot of the southeast and certainly Frankston's in her patch. And she was just talking about the sheer growth that the area has exhibited in such a short time, with a lot of interstate purchaser activity. So, the data doesn't tell the full story.
That is very interesting. And again, it tells the story of price segmentation. I shared
Yeah.
on the show a couple of times where I gave you a call and I said, I saw the monthly numbers for Melbourne. Like, it's absolutely tanking. Like, what's going on there? Are you all right? Do you need me to send you some bread and water or something? But you said it was going gangbusters. It's
Yeah.
just that the first home buyer segment, which is typically lower than the median price, was having a real renaissance due to policy. So what was actually happening was the market was hot. It was just printing lower, so it looked like a depressed
Yeah.
market, and that's a very, very good theory, and I can't think of anything better to explain what's happening in the data.
Yeah, it's just literally a sugar hit in a segment of the market.
So that kind of begs the question, is this Melbourne push driven exclusively or more exclusively by investors than owner-occupiers and upgraders?
No, I think there is I don't know what the balance is yet. Give me some time and I'll get a better feel for it. Certainly, from my point of view, I've had a disproportionately larger number of investors, and my mix has always been, 80% or 70% owner ocs and the residual the investors, but it's switched. But I'm not a perfect poll, because I'm a buyer's agent and investors will reach out to someone like me. Agents are certainly saying that they're still seeing a lot of owner-occupier activity, but as we know, interest rates have bitten and they've reduced people's budgets, and we are seeing first home buyers get active.
Interesting. All right, well, let's look at sentiment. You mentioned that before, that people are expecting the market to do better. It'd be interesting to note how that may have changed with the interest rate announcement that we had, which made everybody sad and every prediction look ridiculous because they kind of bucked the trend. What are the standouts for the sentiment?
There's a couple of things here. The family finances versus a year ago is looking up. So that's positive. We've had, a positive shift of 5% in 1 month, which is pretty strong. The strongest shift we've seen, though, is negative 5.1% on the time to buy a dwelling. So in that 1 month, everyone's gone, oh, the interest rates weren't reduced. It's not time now. And that really surprised me, just how fickle that appears. Because if you read Governor Bullock's speech and answers to her questions when they made the decision to hold rates, she's certainly not saying this is it, we're done and we're holding now. She was saying we're a little bit anxious about applying a rate cut this month, but she was pretty much saying there will be a cut, it's just not happening right now. That was my read of it. And there were a few things that they were hinting at that they just needed to wait that little bit longer to see. And, the inflation figures, while 2.1% was certainly, at the very bottom of our target band, it's still in the target band. And there were a couple of other things that, they just want to see again.
Yeah, they're needing that quarterly data. But interestingly, you rewind to the meeting prior to that, and they were discussing whether a 0.5% rather than a 0.25% was the right way to go. So that's a little bit of a different trajectory. It does kind of seem like there's less certainty about a series of cuts. We're probably fairly confident to get another one, but are we going to get another 2 or 3, as some people predicted, by the end of the year?
Well, the bond markets are suggesting that there will be some rate cuts, or at least a rate cut, but we're never going to get back to where we were. And if anyone thinks that we'll have 2% interest rates on offer to the consumers in the near future, I think they're delusional, because that was emergency measures. And the RBA have certainly included commentary around concern about house price growth. And while they don't make decisions solely based on the market movement of real estate, they're very cognizant of it. And we've had some really strong runs in quite a few of our capital cities. So they're wanting to keep a lid on inflation and stimulating the market quickly after a couple of encouraging reads on the inflation data coming down might be irresponsible. So I think they're just treading very carefully, and we can anticipate there'll be a cut. And we've got a lot of global instability and uncertainty, in relation to trade, but we've also had our employment figures are not doing what they thought they might have done. They've been remarkably stable. So I think that's all factoring in as part of the decision that they've made to keep rates on hold for this month.
And there's been quite a lot of industrial relations activity in the last sort of 6 or 12 months that has helped wages to increase. But an interesting point about housing and how that weighs into the RBA decisions. Obviously, one of the big concerns in terms of the inflation print has been the rental affordability crisis. And when we look at the consumer price index basket of goods to figure out the inflation numbers, rents account for about 6% of that total basket. And, generally it's the second largest expenditure class within that housing category. And rents, if we go back 12 months ago, rents were double-digit growth in many places. Now, far more modest. So that's an important thing that's feeding in. The other stuff that we should talk about is the energy rebates that we've had that kind of artificially decreased electricity inflation and services inflation for gas, electricity, those sorts of things. I wonder if they're waiting to see some unwind from that sort of stuff as well, because that was a bit of a sneaky way to kind of get that inflation figure down. That I feel like the government had pressure in the lead up to the election to achieve that.
Yeah, but I'm sure that they are. We all know what the cost of fuel is at the Bowser. I mean, that's something that every Australian driver would be very aware of. And, it's stabilised. I haven't seen fuel prices getting anywhere near where they were when our government had to step in and cut the excise for a little period of time there.
And interestingly, if we look to global finance markets, the initial blip from the Trump tariffs was a huge spike on the volatility index, but nothing really since then. It seems like investors are taking we've stopped jumping at shadows. We're actually waiting to see what actually happens, because honestly, I don't know if Donald himself knows what's going to happen, because he wakes up and he makes different decisions depending on how warm his coffee was. The markets, I think, have just tired themselves at jumping at shadows, and they're waiting to see what unfolds.
Yeah, fair call.
And I suppose when it comes to things like petroleum and electricity, we are still on a globe with multiple conflicts going on. Obviously the Iranian Israel stoush escalated very, very quickly with
Yeah,
US dropping their massive bombs from the B2 spirits, which is a very, very interesting turn of events. And of course, the Russia-Ukrainian war kicked up to another gear with Russia making their drone retaliatory attacks. And, we've still got elephants in the room like the Chinese Taiwan situation. So there is a fair bit of global uncertainty out there as well.
yeah, there is indeed.
So, what does that all mean for property markets? Well, gosh, if I had the answer, I probably wouldn't be here talking to you guys. I'd be executing on it because my crystal ball would make me a billionaire, but time will tell, I suppose.
Look,
For
it does
this,
have an impact on property markets. And I don't want to sound like I'm just generalising, even though this comment is a generalisation. When we see global uncertainty and volatility in the share market, you'll often see investors turning to bricks and mortar. And I believe that we've certainly seen a bit of that. I know that the conversations I've had with plenty of investors have been based on a deliberate decision to not necessarily completely move away from shares and into property, but to change up their mix of investment. So I think that we can anticipate that will continue.
I think you're right. Periods of uncertainty, we look for stable assets, and real estate is much more stable just because of its lack of liquidity, right? Like you can't wake up in the middle of the night and go, oh
Mm,
gosh, look, something's happened. Like we'll put it on the market and we'll sell it tomorrow morning.
yeah,
It actually takes quite a bit of time to do that. And
yeah.
we're also seeing, some of the metals like gold and silver, I think, is at the peak at the
It's
moment. And
peak.
typically, yeah, that's a way that people react when there is uncertainty. They go to those long held kind of safe assets that ride through those storms. So it's an interesting time to be alive, isn't it?
It is
So
indeed.
from the month that we saw of June, any predictions you want to throw out there about how long Darwin's got to go, whether we will actually see Melbourne doing better? Should rents be increasing in Melbourne? Anything you want to throw and see if it
Gosh.
sticks?
Yeah, you've thrown me a lot of options there. Look, there's nothing to suggest that Darwin's about to slow down. If we just track the monthly performance, the pace of growth has been strong and consistent. So it's not going to suddenly hit a wall at all. Will Melbourne show growth? Yeah, I think we're seeing modest growth. Let's talk openly about Melbourne. It has delivered growth, albeit sub 1%, since the start of the year. I think our greatest growth story was 0.76% at the end of February for the Feb data, and I was pretty excited to see that because it reflected what I was seeing on the ground. The market segmentation is still very much a definite thing to take into account in Melbourne. We're not seeing a surge in the higher priced properties, and I've had a few auctions where the $3 million plus price segment, they've still not been predictable. The agent might think that they've got 3 people on it. You get to the auction and it passes into me. I've had a couple of occasions where that has actually happened. But if you're on a $700,000 property, there's not a chance of a pass in. You know that it's going to be highly competitive and they can underquote it as much as they like because they're going to have, over 5 bidders. I've had a couple of auctions where I've looked around and counted the different bidders and we've had anywhere between 8 and 10. That's a really hot auction. So I think segmentation is still something that the data nerds need to take into account when we talk about Melbourne data.
Speaking of which, I might have a look at our own data and see what the average price point for Melbourne
Oh,
purchases has been in the last 6 months, because
I
I
would love that.
suspect it will be quite a bit below the median, which lends evidence to your theory, which I think, will be really interesting to see,
Well,
although data will tell the story, won't it?
I'm going to make a firm prediction for you then, and you can hold me to it.
Yep.
I think that your data will show that between 675,000 and 800,000, we've had particularly strong buyer participation.
Okay, excellent. All right. I'd be hard pressed to bet against you, but we'll see. I'll do some homework. So that
Awesome.
is June, the month that was. Dave will be back for the next one. We're sorry you missed out on him for this
Yeah,
particular
we'll talk
one.
about lending. We've missed you, Dave, and we hope that the road trip's going really well.
Absolutely. All right. Well, thanks for listening, and we'll see you next week.
See you next week.